This screencast is focused on Summer 13 Question 2, focused particularly on consolidations and exam technique around approaching consolidation questions. So I've assumed you've read through the question and maybe ideally attempted some of it, so if not, pause this screencast now and go right through it, read it from start to finish firstly, and then start on some of the main adjustments. So again, I tell students you have to have a structured approach to approaching these exam standard consolidated questions. The first question or step being read the requirements. So in this case we're asked for two financial statements, the consolidated SPLOCI and the consolidated statement of financial position. We will also do the consolidated statement of changes in equity just for completeness. So once you have that in the back of your head that we're going to prepare the three statements, have a quick look at the background information. Again, hopefully what you've highlighted here is I would have put a circle around other income from the parent. That may be involved intergroup dividend. So we don't know yet, but it's typically an indicator that there could be an adjustment. And the other thing I'd be looking out for here is we have two separate investment lines, which is good because we have two separate investments. So we don't know what type they are yet, but you're always just checking what am I given in the financial statements and does anything stand out. So there's nothing else unusual in the financial statements. So then we just go to all of the additional notes. So we have 7 notes. I typically tell students make sure you look through each of the notes first before you start the question, because some of the notes may be interlinked. So we'll just briefly down through the question. Ideally you'll have looked at these before and highlighted yourself, but I'll just summarize the key things from each of the notes. So the first thing is the parent, which is Able, purchased 8,050,000 shares on the 1st of January 2011. So this was a prior year acquisition. You've owned it now for 2 years, and you bought 8 million shares. So be careful here, that means you owned 80%, because they're 50-cent shares, meaning you 10 million shares, so that would be a subsidiary. You're given the retained earnings at the date of acquisition, and there's also a fair value adjustment. And so you're told fair value of property is understated. And we're also told the fair value of the NCI, so we're going to use method 2 to value the NCI. So again, nothing unusual there, but try and make sense because some of these notes will be linked, so it doesn't make sense to jump straight into the goodwill calculation till you read briefly down through each of them. The other one, so we know that's to do with Bean, and we know how much we paid for it. We also have an investment called Carl, which is 25%. So they've appointed a director, so that will be an associate, and I put a big circle here. That's a mid-year acquisition. You bought it 3 months into the current year, which is 2012. So mid-year there I'd put. The next one is intergroup trading between the subsidiary and the parent. So all I'd really highlight there is from sub to parent. And we'll come back and do that. We also have intergroup balances at the year end between the sub and the parent, but they don't match. So we have a check in transit at year end, so we're going to have some adjustment for cash in transit. So again, I'm assuming you've read through these, but that's really very quickly how you go through each of them just to note what's going on. You also have intercompany balances between the parent and the sub, or sorry, parent and the associate. So again, there's particular rules under IAS 28 how you deal with those. We'll come back to that. And the final thing then, as we've highlighted before, Able paid dividends during the year. So again, that's the parent paying a dividend. That will be relevant for our statement of change in equity. And Bean paid a dividend as well. And note here, Bean is the sub. And you're told that these payments have been accounted by debiting retained earnings and crediting bank. And Able have recorded dividend income in this SPLOCI. And we can see that there, that's what their dividend income is. So we know some portion of that is actually dividend from the sub, which has particular adjustments required. And this is one of the main reasons, note 7, it's why I tell students to read all the notes first. You're told the depreciation policy for the year. That's relevant for note 1. Because where you have a fair value adjustment, you need to depreciate as well. So again, that should only take 2 or 3 minutes, but it's good to read the requirements, have a quick look through the financial statements for anything that stands out, and then a quick note through here, just so you can get a sense of we've one sub acquired 2 years ago, we've one associate acquired during the year, and we have a number of different intergroup adjustments that we need to deal with. So that just kind of gets the lay of the land. Doesn't take that long, but it's very valuable so you understand exactly how you'll approach the question. The next step I tell students is to set out the structure of your answer before you start. So what I typically say is leave one page for the SPLOCI, And sometimes you may want to put in the columns for the parent and the subsidiary, leave adjustment column or two, and have a group column as well. Some students prefer to have them slotted in, that as you go through the adjustments then you can slot in the figures as you go, so it's a lot more efficient. You'll notice here I have this yellow box for 12 out of 12. That is a good reminder to ask yourself, how many months of the subsidiary am I putting in? Because we own Bean for the full 12 months of 2012, remember we bought at the start of 2011, then we have it for the full year, so it's the full 2310 of profit, which is here, that will go in. But it's always good to have that yellow box or some variation to remind you to put it in. And of course, don't forget to leave a line or two, because you may have a share of profit from associate or joint venture in the question, so don't be afraid to leave a spare line or two. You won't get deducted for that, but again, it'll look a lot worse if you're trying to shove in or fit in them in 2 lines or 1 line later on in the question, because you didn't leave space. So do leave enough space. Same structure for the statement of financial position. I do the parent plus the sub plus adjustments and then the group. And again, I probably leave 2 pages here because there's a lot of line items. And don't forget to leave some space for an NCI. And typically I might leave 1 or 2 spaces up here if you have goodwill, etc. Or you can do them on the same line as the investment. But again, a lot of students will prefer to set up those structures at the start, first 2 or 3 pages. So as you go through each adjustment, then you just slot them in and you'll get your marks as you go. And you don't have to repeat yourself at the end of the question when you're trying to fill in the financial statements. I then will leave 1 page at the end. We weren't asked for it in the question, but it's good for practice to do a consolidated statement of changes in equity as well. So at the very start of your booklet then you'll have left 1 page here, 2 pages here and 1 page. So that sets up the structure, and then I come down and I'll do my journal workings. We'll call them journal adjustments. And then I leave my main workings over here. So you'll see as I go through the question what I split between the smaller adjustments, which are essentially relating to each of the notes. I make a journal adjustment for the notes. And then the bigger workings are typically 4 main workings. So working 1 would be goodwill. Come down a bit. Working 2 would be group retained earnings. Working 3 would be the NCI. And then if you have it, and we know we do, working 4 is the associate. So I typically have those as separate workings on a separate page, because that's where the bulk of the marks are going for. That a lot of the time when you'll be doing these smaller journal adjustments here, so your fair value adjustment or intergroup trading, they will feed into a number of items here. So it's useful to set that up as you go. It makes it a lot more efficient when you're working through the smaller adjustments. You slot them in so you have a one-pass approach through all of the question. So once you've that set up, and that will be very similar for a lot of the questions, setting up the structure on your exam booklet, we're going to start straight into the first working, which is going to be our goodwill. Right, so we'll set up the goodwill working. Again, hopefully you've tried this already. So the goodwill working, I typically start with the investment, or if it's the value for the NCI, and I split it between total, the parent share, which as we know is 80%, and the NCI share, which we know is 20%. So again, there's no point trying to just wait for me to walk through it. Try as much as possible yourself to see do you understand and can you get the calculation out. So the investment, we know we paid for being 14,250. And we're also told in the question that the NCI is measured at its fair value, which is in the note 1, 2.8 million. So 2800 is the NCI. So just make sure this is, just change these to tidy them up. So 2800, and then we need the fair value of net assets at acquisition. So remember, the date of acquisition was the 1st of January 2011. So you're going to have ordinary share capital, we're told here. Bean doesn't have any share premium. It doesn't have any revaluation surplus, but it has retained earnings. So the ordinary share capital is 5 million. And the retained earnings, you're told in the question note 1, is 8250. So you're told what the retained earnings were at that date. We also have a fair value adjustment, And I'll reference there Journal 1 to show the examiner where to find it. And we'll go over now to our simple adjustments and we'll say, what's the fair value adjustment? Where we're told here that property is understated by 320. So in this case, you're going to debit PPE 320 and you're going to credit the goodwill working 320. So again, it's nice. The smaller adjustments are kept Journal 1, Journal 2, and they feed into the bigger workings, and some of them may also feed in to these statements. So here we have 320, giving an overall fair value net assets at acquisition of 13,570. Now, one thing to know when you do your little journals here, I always tell students, try and slot them in. If you have an adjustment for the statement of financial position or the SPLOChy, put it in as you go. So here, this 320 went here to impact our goodwill, but the other 320 should slot in as an adjustment up here, 320. So that's why a lot of students prefer to have this structure set up, that when you do the workings, you slot it in, you've got your marks, and you never have to repeat yourself at the end of the question. So it is very efficient in terms of time management. So that's our goodwill working, or our fair value adjustment done. And now we split that between 80% here and 20% here. So the goodwill here, if we look at the difference, is 3394, and the goodwill attached to the NCI is 86, giving total goodwill for the year. Goodwill at year end is 3.48 million. And of course you can get that by adding these two together and taking it away from 13,570 as well. So we just did it separately to show how it's split up. But the overall answer is goodwill for being acquisition is 3,480. And we know we've no impairments during the year because we've already read through the full question. So again, it makes sense, slot it in as you go so you won't have to come back. So I reference here any of the bigger workings. I put a column working 1, 3,480. So you don't need to put in adjustments here. That if the examiner can see this, your goodwill working, you take out the investment in B now, you bring in all the assets and liabilities, and you have 3,480 left in goodwill at the end of the year. And the examiner can see that is cross-referenced to working 1. So not the worst of goodwill workings, but the benefit is having the structure set up, you can just slot them in. We'll also finish off the fair value adjustment depreciation while we're at it, because they're very much related. And we know from the question note 7 that they depreciate over 50 years. And that goes to cost of sales. So here we're going to have debit retained earnings, debit NCI, and credit PPE. Because remember, you have to split it between retained earnings and NCI, because this is a fair value depreciation adjustment in the subs accounts. So that means it will impact the NCI and the group retained earnings. And you have 2 years, so you have 2011 and 2012. So that's important because it was a prior acquisition. So it's 320 of the fair value adjustment divided by 50 multiplied by 2. So the full depreciation, if we do decimals, is 12.8. For the NCI, 20% of that will go to the NCI, which is 3. And if you want to put it out, it's 2.6. And then the residual, which is 80%, goes to group retained earnings. So the key thing is here, that's actually split between 6.4 goes to the SPLOChy, and 6.4 is statement of changes in equity. So that's important, that half of them is for the current year, 6.4 in cost of sales, the other half is for prior year. So again, don't make sure you realize that's important, realizing it's current year, prior year. So then just slot them in where they need to go. We're reducing this, so we'll put the minus 12.8 in property, plant and equipment. So again, that just rounds to 13. So we've slotted that in. In cost of sales, we're going to do a minus 6.4 because it's additional depreciation for the year that needs to go in, only for the current year, 2012. The statement of change in equity portion will show up when we do the opening retained earnings, so don't worry about that. And again, don't forget to slot these in here. Fair value depreciation adjustment, and I reference again journal 1. For group retained earnings, that's going to be a minus 10.2. So again, I'll just put that here. And similarly, I'll just slot it in for the NCI calc so I don't forget it again. And this will be a minus 2.6. So again, it's just rounding there. But the key thing is I'm doing one approach or one sweep through everything. I've set up my key workings. This is what the key marks are going for. And I've told the examiner, look where the solutions are coming from. So it's all very much captured in one. This has gone to the PPE. That's gone to the Splocky. They're gone to their bigger workings. So that's your fair value adjustment done and your goodwill working. So off to a good start. The next one is now we're dealing with the associate. So the associate we bought mid-year. And again, remember under IAS 28 you always check for a gain from bargain purchase at initial acquisition. So associate, check for GFBP. So it cost you, if you look in the question, you paid for your share 4750. So put that over here. And the net assets at acquisition, so you're told no fair value adjustments, are ordinary share capital and retained earnings. So the ordinary share capital is 8,500 or 8.5 million. Retained earnings is a small bit of a trick, and you need to make sure you're comfortable with that. It's the retained earnings on the 1st of the 4th, 2012. You have the retained earnings at the end of the year, 15,520, and you have the profit for the year. So to get that back, you're going to do 15,520 minus the profit, 2,905 times 9 months. And that will get you back to your profit for the year. So a profit should say our retained earnings at the acquisition date. So if you had it at the end of the year, you know how much profit you made during the year. That'll give you retained earnings at the acquisition date, which gets you to 21,841 is the net assets at acquisition, and a 25% share of that is 5,460. So again, we can see here very clearly we have negative premium, or in this case a gain from bargain purchase. And you know, if you have a gain from bargain purchase in an associate under IAS 28, you must make an adjustment. So what catches out a lot of students there is there's no real clear rule that you have to, you're not told to do it in the question. You have to remember, if you have an associate, you need to check for a gain from bargain purchase. So the adjustment here is debit investment in associate and credit group retained earnings. So that'll be 710, 710. And note, this is a current year adjustment, so it will go into the Splocky for the 710. So it will go into the associate line in the Splocky because it's a gain in for a mid-year acquisition. So I'll just, the investment associate line item I leave is here, which I just relabeled from investment in Carl. What's it called? It's called Carl. So just relabel that investment associate, and I put an adjustment there, 710. And the share of profit from associate, I put one adjustment, 710 there as well. So you can see it just reminds you, you slot them in there, you put the 710 in group retained earnings, gain from bargain purchase associate, journal 2, 710. So you can see there's a few things, moving parts you need to do the whole time. And don't forget then for your associate, gain from bargain purchase, journal 2, 710. So it's nice to have everything set up, because then you just have really, once you have the adjustment done, you slot in as you go along. So that's your initial setup of the associate complete. And we'll move on to the rest of the question. So we'll come back to the associate to finish off the post-acquisition profits. You may want to do it now. I'll just leave it till the end of the question. So our journal 3 then comes on to the next note, because I'm following note by note, is we have intergroup trading. So in this case, it's the sub is selling to the parent, And again, that's important because there's a particular set of adjustments then if that is the flow of the transaction. So we're told during the year there was an invoice value of 4.3 million, charging a markup of 15%. And a fifth of the goods remained in inventory at the year end. Right, so in this case, first thing is, you have three things to remember for intergroup trading. One is the top line adjustment. So we're going to debit revenue, 4300, and we're going to credit cost of sales, 4300. So both of them are going in. Now again, that reminds me, this here should have been a capital S as well. So when you're going and doing your solution, you should have a capital S there because that is relevant to the subsidiary. So when you do their NCI profits, that S should be there. Now this is not relevant here, but just because it reminded me. So you're doing the 4300, making the adjustment, reducing revenue, and plus 4300 here to reduce cost of sales. But again, that's a mark got, so it's rather get the easier ones at the start. The next one then is to calculate the unrealized profit, revenue, cost, and then profit. So the revenue is 4300. You're told in the question it was a 15% markup. So that means this is 115% of cost. That's how markup works. So to get the cost, we divide by 1.15, meaning our profit was 561. So on that transaction, the sub Bean made a profit of 561, and a fifth of the goods, so the unrealized profit, which is 20%, is 561 divided by 5. So the unrealized profit adjustment is 112. And remember, it's the sub making this, so you need to split it between debit, group retained earnings, debit NCI, and then credit inventory. So it's a particular set. It's slightly different if the parent was selling the sub, but here you're reducing inventory by 112. 20% of the hit goes to the NCI, and 80% of the hit goes to the group retained earnings. And again, as before, just bear in mind this is current year adjustment, and it's to do with the subsidiary, because the sub, the unrealized profits are sitting in the sub, so you're going to make the adjustment to the sub's accounts, and that's also going to impact the NCI split at the very end of the P&L. Right, so what we're going to do here is come up. Now you can either put this in admin expenses, or more than likely we're just going to add it in here, minus 112. I'll use the formula just to make sure it balances at the end. So minus 112, and you put the full amount in because the split will happen at the very end. So I've just layered in two adjustments there, journal 1 and journal 3, so don't get too confused. Likewise, I reduce inventory by the 112, so doing everything as I go. And I slot these two, unrealized profit, journal 3, for the NCI. I'm going to take off 22. And for the unrealized profit up here, journal 3, so I show the examiner clearly where they're coming from, I'm going to take off 90. Right, so again, I'm getting a lot of marks as I go along, and I don't have to go back over any working at the end because I've slotted them all in. So the top line adjustments, the unrealized profit, and the other one is the intergroup balances, which is actually on the next line, so we don't need to worry about that. But typically when there's intergroup trading, there's three adjustments. There's the top line revenue cost of sales, there's the unrealized profit, and finally then there's the intergroup balances. So we'll now look at journal 4, which is the intergroup balances, and we're told here that Abel's trade payables, so the trade payables in the parent, are standing at 420, but the trade receivables in the sub are standing at 650. So there's clearly a difference there to the tune of 230. So again, it's not just a straightforward elimination because there's a mismatch. And typically there's two reasons for a mismatch: either goods in transit or cash in transit at year end. And in this case, you're told that at the year end, the parent forwarded a check for 230, and this was not received by Bean until January 2013. So essentially the 230,000 fell into a black hole. Able would have reduced their bank and reduced their trade payables, hence it's lower than the trade receivables have been. But again, they haven't received it in being, so they haven't accounted for that payment. So typically we bring it back into the parent just to be consistent. You can do the adjustment in the subs accounts as well, but it's useful just to be consistent so you can follow the solution. We'll say bring the money back into the parent's accounts, 230, and we'll again increase our trade payables as if we've never paid them. So debit bank, credit trade payables. Now you have the updated trade payables is 420 plus 230. The original trade receivables are still 650. So now you have no difference. So it's nil. So now, and the final one where a lot of students forget is you need to debit trade payables, credit trade receivables to eliminate them. So students a lot of the time will do this adjustment for the cash in transit, but they don't actually go on and then eliminate them out. So don't forget you have 4 adjustments now to make to your statement of financial position. So we just go on up here, increase this by 650, increase it by 230, reduce our trade receivables by 650, increase our trade payables first by 230, and then reduce it by 650. So again, you're just making the 4 adjustments as required, so you don't have to come back to that adjustment again. You're fully finished with it, and you've got your full marks. Right. The other note here is a very short one, where you have a matching balance between a parent and an associate. But the key thing to remember here is the associate is not a group company. You do not consolidate the balances, therefore you do not eliminate them. But again, don't just ignore it. I'd write a small little point. Do not remove associate balances as not a group company and not consolidated. And I just referenced there to be sure IS28. That's all you need to put down to get the mark. But a lot of the time students, they know what they're doing, but they ignore it. They don't write down why, and you won't get your marks. So just make sure if you are getting an associate balance that you actually explicitly write down why you're ignoring it. So our journal 5 then is to do with the dividends. So you have 2 dividends been paid during the year. You had parent dividends of 1350, and again that's already been accounted for, so we're not too worried about it. But the good student there will label that SOCE. To remember, if a parent paid a dividend during the year, that will show up in the statement of changes in equity at the end of the year. The other thing you have to remember as well is you had Bean paying a dividend. So Bean dividends were 440, of which the Abel's share, which is 80%, would have been 352. And that's important because Abel's share is 352 and the NCI share is 20%, which is obviously the difference is 88. So Abel's share, you need to remove from other income. So remember, when it's paid, there's no other adjustments. It's already been paid, so you don't need to make any adjustments to dividend payable, dividend receivable. But you know Able is accounted for that in the P&L. So within this 850 other income, some of that 352 needs to be removed. So if we go up here, we need to take out 352 because that is intergroup dividends as part of the Beans dividends paid during the year. And we only remove our portion. The other NCI share, and this is important again, it goes to statement of changes in equity. So in the NCI column, this will be in the retained earnings column. This will be in the NCI column showing the NCI dividend. So it's always, when dividends are paid, they're very straightforward adjustments, but just to remember that you need to bring in the NCI dividend as well to show it. Okay. And the final adjustment then, so we've made every adjustment that we have, but the other one is to finish off the associate firstly, and we'll come back and we'll finish off the rest of the main workings then. So we're looking at Journal 6 here, post-acquisition profits from associate. So what you look at here is return earnings at year end. retained earnings at acquisition, and that gives your post-ac profits. So remember here, we only owned it for 9 months. At the year end for Carl, they had retained earnings of 15,520. When we bought them, the retained earnings were, and we had to do an adjustment, 13,341, meaning the post-acquisition profits were 2,179. And Abel's share, or the group's share, which is 25% of that, is 545. So remember, you have to do the subsequent topping up or down of the post-acquisition profits from the associate as well, and this is all current year, so that's important. So you're going to debit investment in associate, and you're going to credit the group retained earnings. So here you're going to debit 545 and you're going to credit 545, and bearing in mind here that is for the year, because it's all current year, because you bought it during the year. So that full 545 will go into this blocky. So we put here for our associate post-ac profits, journal 6 is 545, and for group retained earnings, post-ac associate, journal 6, 545 as well. And don't forget finally to put it into your P&L, 545 in the associate share of profit line. Now you can put it in here as well. Now really we didn't even need to put in that 710 because we're going to have a different working for it. So when you have a separate working, you don't really need to put the adjustments. We're just going to cross-reference that working for, and we'll finish that off in a second. So you can put them in there if you wish, but typically when there's a couple of adjustments, I do a separate bigger working and I just slot in the final answer, similar to goodwill. So that's all the adjustments done so far, and we've labelled some of the key things we need to come back to. So the next thing we're going to do now is finish off our main workings. We've goodwill finished. We now need to finish off group retained earnings, and the two main things we're missing are the starting point, which is always the parent retained earnings at year end. So in this case, the parent retained earnings at year end is Able, which is 29,580. So you have 29,580 as your starting point. Then you have all the relevant adjustments, some related just to the parent, some for the sub. And the final thing you need to put in is the sub post-ac profits. So you need to bring in, remember, the subsidiaries post-acquisition profits, because we don't have that done yet. And that's typically the last thing we do. So in this case, the post-acquisition profits will be retained earnings at the end of the year, which are 14,480. Let's do it here. 14,480. Retained earnings at acquisition, which you know from the goodwill working were 8,250, meaning the post-acquisition profits were 6.2 million, of which you're entitled to 80%. So again, don't forget, you have to divvy it up between the group and the NCI. So Bean has made profit of 6.2 since acquisition, of which you're entitled to 80%. So that's typically the approach we take. We put in all the smaller adjustments. At the very end, then we bring in the parent to start it off, and the share of the post-acquisition from the sub. And if we tot all them up, then you get group retained earnings at year end to be 35,719. And that is the figure that I'm just going to slot into my stable financial position, working 2. So I don't put in any adjustments here, and I just literally slot in the figure, and the examiner can find where it's coming from, 35,719. So it's nice and clean, it's clear where the calcs are coming from, and you have a lot of the stuff done already that you're not going back over every adjustment. Because the more you're going back, the more you're wasting time. Same for the NCI. So again, I've probably left too much space here, but you're better to have too much space than too little. Your starting point for the NCI is always the value at the acquisition. So that's coming from working 1. Because we initially valued the NCI at fair value, 2.8. We have the relevant adjustments that we've done already. We've only 2. And what we also have to bring in then is the subs post-acquisition share again. So in this case, they're going to get 20%. So you divvy up 80% to retained earnings, and the final 20% then will go to the NCI. So it's nice to leave those till the end because they're very much related, and there's only then totting up to finish off. The NCI at year end will be 4021. So 4.021 million. And again, very similar structure, working 3, 4021. So the examiner can see where they're coming from. And it's nice, and you'll get your presentation marks as well. Because remember here, there are 2 marks going for presentation. And the very final big working we have is the associate. And how you start the associate is you start, remember, initially at cost. It initially cost us 4750. We made a gain from bargain purchase, so that will bring us up to 5460, which, if we go back to our adjustments, is the true value of our share initially. So that's just bringing us up to true value. And then you add on the post-acquisition profits to get the associate at the year end to be just over 6 million. And again, that will cross-reference working for 6005. So once you're finished all your adjustments, I finish off the 4 key workings, and this is where the bulk of marks are going for in any of the Consol exams. Is getting those workings right, because they feed off the smaller adjustments and your knowledge of, for example, how to do post-acquisition profits for a sub. The rest of the finishing off the statement of financial position is very straightforward. You're really just adding across parent plus sub plus adjustments. So it's really totting at the end. And the nice thing is, if you don't get that far, you still have the majority of the marks got. So you don't need to worry about losing too much, because you have the majority of the workings and the adjustments complete. Same here, parent plus sub plus adjustment for all of those 3, getting you current assets and total assets to be 88,280. 1 or 2 small things to watch here. You never include the share capital or any share premium, etc., that were pre-acquisition for the sub. So it's really only the parent that you add in. Parent balances, because anything to do with the subsidiary would have been removed from the goodwill calc. So anything pre-acquisition would not be included. They should be removed, because they're all, that 5 million has gone into here. We've already done our working for retained earnings, and we've already done our working for NCI. So there should be nothing new there. We're just slotting in, giving us total equity of 69,740. No adjustment to long-term borrowing, so it's just parent plus sub. 2 adjustments to trade payables, so we add them all across. So that gets us to 9920, and again, the other 2 are just very straightforward, adding parent and sub. So you can see the big benefit, if you have a solid method of how you go through the Consol question, it can make it very streamlined. And the less you're thinking about how you're going to approach it, the more time you have then to think about the particular adjustments and how you're going to go through them. But the key thing is, start with your smaller adjustments here, build those into bigger workings, and once you have those finished, the rest is just totting across parent plus sub plus adjustments. So that's our statement of financial position complete. For statement of profit and loss or other comprehensive income, the first thing is just to tot across right the way through, because you have your adjustments complete all here, and we only have 1 small working to do at the end, then to split the subsidiaries' profits between the owners of the parent and the NCI, and that's where our S label will come in. So in terms of adding across, it's just parent plus sub plus adjustments. So nothing too complicated across here. This just takes a small bit of time to tot everything up, but again, I wouldn't be worried about totting up too much, because the majority of the marks are going for actually putting in the adjustments. So I'll just tot them along to make sure I have them all in. So I have all the figures so far, giving me a profit before tax of 11,049. So you're just subbing them up as you go along, parent plus sub plus adjustments. So we just finish off adding the tax across, and that gets us to the group profit for the year of 9754. But remember, and a lot of students stop there. You have to split that by profit attributable to either the owners of parent or the NCI. And there will be a good few marks going for that to see do you understand, well, of the subsidiary profits for the year, the NCI will be entitled to 20%. But unfortunately, a lot of the time it won't be just simply, well, that's 2310 times 20%. It's not going to be 462 because you made a number of adjustments here to the subsidiary's profits. And that's why the S label is very useful. We made a 6.4 adjustment for depreciation for the subs profits, and we also made a 112 adjustment for intergroup trading. So what I do there is to calculate the NCI's share. It starts off with the 2310. You minus 6.4 for depreciation, so 1 year's depreciation, and you also minus then 112 for the unrealized profit inventory for the year, and you multiply that by 20%. So that's important there that you understand. That's why we talk about the S label, because when you come to the very end here, you need to be able to track what adjustments you made to the subs profits only, and you made 2 adjustments during the year. So that gets you, just change that format, 438, with the difference of course going to the parent. So that's the split of the profits, and there will be a good chunk of marks going for that. So make sure you're comfortable how to split the profit at the very end between the owner of the parent and the NCI. So that was the core chunk of that question, but you can see finishing off the financial statements is very straightforward as long as you have the actual adjustments treated as you go along. Whereas if you leave this template and set it up at the very end, you now have to go back over every single adjustment and figure out, well, where does that go, where does that go, and it's a lot of duplication of effort. So try and be as efficient as possible, but that will come with practice. The very last one we're going to look at, we're not asking the question, but it is one where students are weak on, is the consolidated statement of changes in equity. So remember, your starting point here is the number of headings will be the number of line items in equity in your statement of financial position. You can only really do this at the end because you need the answers from both the statement of financial position and also from the SPLOCI. Alright, so here we have ordinary share capital, you have share premium, you have reval reserve, you have retained earnings, NCI, and total. And all I'm doing is taking the columns that I have in my equity section and putting them on the horizontal. So we'll just say here, all of these are going to be thousands. And we're going to have an opening balance. And we're going to have a closing balance. Now, kind of counterintuitively for the statement of changes in equity, you start at the closing balances because you know they are the balances at the year end. So closing balance in ordinary share capital is 20, share premium is 4, reval reserve is 6, retained earnings is 35,719, and NCI is 4021. So that's your first step, is the number of columns will be the number of lines in the equity section, and you start with the closing balance and now you work backwards to get to the opening balance. So that's the kind of steps you approach. And now what you're trying to do is slot in here, right, what will impact the movement in equity during the year. And in this case we have two things. We have our dividends from, if we go back, we've labelled them already if you remember, from Journal 5. So Journal 5 is dividends, and we also have profit for the year. Right, so we don't have any acquisition of a sub during the year because we acquired the sub prior year, so we have no acquisition, nor do we have any disposal or anything in this question. So actually you don't need that many spaces. We can bring it up. The dividends were 1350 for the parent, and we said that goes into retained earnings, and it was 88 for the NCI, so that's why you need to label it, because they go in here as well. And every point you put in is correct, obviously is worth a mark, or at least half a mark, so make sure you try and get as much as possible in the shortest amount of time. So the total dividends there or 1438, and the profit for the year you need from the Splocky. So you can't do the statement of change in equity until you have this split of 9316 for the parent, which goes to retained earnings, and 438 for the NCI, which goes obviously to the NCI column. So you see you're really feeding off what you've done already. So it's a nice requirement that comes up, but a lot of students are weak in it. And then we just really back into what we think the opening balance is. So here, the ordinary share capital, no movement, so the opening balance must be 20. It's same for the other two, that the opening group balances, they haven't changed, so they must have been the same as the closing. Now for retained earnings, we said we started off at 35, and you take off the sum of the movement to say if we had those movements during the year, we must have started with 27,753, because when we add all of them together, we get to 35,719. And we will prove that in a second, that 27,753 is correct. Same logic for the NCI. If we ended up with 4021 and we had those movements during the year, how much do we actually start with? And we think we start with 3671. So again, we can prove, and I'll put that in orange to prove that that was correct. Put in this color. So again, what you're essentially doing is you don't need to prove them, but it's useful as a sense checker whether you're right or not. To finish off, you just back in, and they are the plug figure that when you have this plus the movements, you get to the closing balance you already have. So we can prove proof of opening group retained earnings. So you have the parent, you have the sub, and you have the associate. So let me just change all those. So the parent, well, what was the retained earnings at the opening position, which is the 1st of January 2012? Well, the parent's retained earnings would have been, and be careful with this, there's a small bit of an adjustment. The closing retained earnings were 29,580. Profit for the year was 6,660. And don't forget they paid a dividend as well. So in this case, to get the opening retained earnings is 29,580 minus 6,660, which is the profit for the year, but add on the dividend that they would have paid as well. You need to get back to the parent initially. That will be 24,270. So in this case, your closing position working back to the 1st of January, taking off the profits. But don't forget they would have paid a dividend which would have reduced their retained earnings during the year, so you need to add that back as well. So the parent's opening balance was 24,270. The sub, remember, you had it for 1 year. So you did have it for all of 2011, so you would have had some post-acquisition profits. So how to get that? You start off with the 14,480, which is the closing retained earnings. You take off the profit for the year, which is 2,310. So to get back to January. But remember, they also paid a dividend. So that's your 440. So that gets us to what the retained earnings of the subsidiary were at the 1st of January 2012. But of course, we're more interested in what was the post-acquisition. So you take off the 8,250 and you multiply by 80%. So that's a bit tricky. The first thing here is to get what it was at January 2012, which is a similar approach to which we did with the parent. That gets you to 12,610. But what we're interested in for the sub is, well, what was the post-acquisition share of profits? So to get that, you take off the retained earnings and acquisition. So for 2011, Bean made a profit of 4.36 million, of which you're the sub or parent entitled to 80%. So at the opening date, you would have brought in 80% of that 1 year's post-acquisition profits, which was 3,488. Carl, the associate, would be nil because it was acquired during the year. So that means you couldn't have any impact on group retained earnings at the start because you didn't acquire it until April of 2012. And that should get you to 27,758. But we notice here that doesn't really match up. And this is where the final Journal 1 fair value depreciation adjustment comes in. That we had that labelled 6.4 statement of change in equity. So we know 6.4 of adjustment would have been for prior year subs profits. So you can bring that in by saying the fair value depreciation here for the group would have been minus 6.4 times 80%. That gets you to your 27,753. So that is how the prior year adjustments show up. You typically won't be showing it because you don't have to prove this, but for learning or tutorial purposes, it's useful to see how it flows through into opening group retained earnings. It's still split 80-20, 80% going to group retained earnings. And we can now do the very same approach for the proof of opening NCI. You start with the value at acquisition and you go post-ac profits. And of course you'll also have the journal 1 fair value depreciation. So to get what was the opening value of the NCI the 1st of January 2012, well, when you bought it, when you bought Bean, the NCI was initially recognized at 2.8 million back in the start of 2011. But over 2011-2012, over 2011 period, they earned post-acquisition profits. And we've calculated this up here to be 4,360. So remember we did that formula out before. So the 4,360 was the profit that the NCI earned, and go back and look at it for the proof, in 2011, so the prior year, and they would have been entitled to 20%. So remember, we're trying the opening NCI on the 1st of Jan 2012. So that means we're interested in what they earned before 2012, which is the profits for 2011. Because again, you bought it on the 1st of January 2011. So 872, but again, if we add them up, we're at 3672, which is slightly too high. But of course, the NCI should also get hit with 20% of this 6.4 prior year adjustment. So here then, it's minus 6.4 times 20%. That's similar to here. So the full adjustment is gone in of the 6.4, but it's split between opening group retained earnings and opening NCI. So again, that's a very comprehensive question showing you right through from the initial setup of the question, how to lay out your journal adjustments and your more detailed workings, how they then feed through to the relevant statement of financial position, the SPLOChy, and also more importantly at the end, that you can prepare a consolidated statement of change in equity. Now you don't really need to know how to prove it back because you may not have time in the question, but to understand exactly where for example, the prior year adjustments go in, that's how they fit in, and how you can prove that these answers are right when you back into them. So that was a very good exam standard question looking at Summer 13 question 2 and Able PLC.